All right, let's move along here. So, sorry to go fast. We're running just a little bit behind. So the next segment is our panel. We have 4 distinguished guests waiting in the green room. They're going to pop on here in a second. They're leaders in the industry. They all have a little bit different take, I think, on technical analysis. And they might not even have a traditional view of technical analysis, but we're going to find out from them. So let me introduce and have each one of them join. I'll bring them in every bit at a time. Here's our guys. We got one more, Mr. Jeff Tompkins. Hi, guys. How are you? Can you hear me?
How's it going, everybody?
What's up, everybody?
All right, you're there. I think, Jeff, you might be on mute. I'll unmute you. There you go. He's going to get it.
Hey, guys.
Good. Good to see you. So this is just a panel. Super simple. I'm going to ask the questions. You're going to give the answers. If you need to share a screen, just go ahead and do it, midway through. But what we're going to first do is go around the board. We've got about, 45 minutes or so. I got, a handful of questions. I'm sure we'll get some questions from the viewers. We'll try to answer those along the way. But let's first do introductions. Rob, I see you first, and we're just going to go around the wheel here a little bit. So just give us a brief bio about yourselves, and we'll move along and tell us about your experience in the industry.
All right, I'm Rob Booker, and I didn't see my name on the wheel, so I refuse to participate in any of this. Just kidding. My name is Rob Booker. I've been trading for 22 years. I was a commodities trading advisor from 2006 to 2011. I was primarily a currency trader for the first 13 years or so. I wrote a book, Adventures of a Currency Trader, which sold a total of 3 copies. I was the host of the Traders Podcast, which was a podcast before podcasts were even a thing. And then I actually sold that podcast and my radio show and YouTube channel a few years ago. And now I'm a retired trader who only trades when the trade is so good, I cannot help but take the trade. So it's nice to be here. I really appreciate the invite.
Great, Rob. Thanks. Jason, what do you think?
So I'm Jason DiLorenzo on Twitter. I'm the Wizard of Ops. I'm an RIA currently. Been options trading for about, 11 years or so. I am not a market maker like all your other guests, but basically I'm an economist that looks for inefficiencies in the market, and I like to trade them. We have also a data platform called Volland, www.vol.land, which is designed to give you dealer positioning by the Greeks in about 200 equities. So very kind of diverse business model. We are kind of focused on non-traditional sources of edge, and particularly as it relates to options, since options have a lot of aspects to them and a lot of different kind of traders. So you can find a lot of edge there. So
cool. Thanks, Jason. Appreciate it. Chuck, what do you think? How you doing, man?
I think a little at a time, Lex, as little as I can. Chuck Fulkerson with TradersArmy.com. Hope you guys are having a great day. Glad to be here. I've been I'm primarily an options and futures guy. I've been trading for about 15 years. I make the joke that when I started, I didn't know the difference in a stock and a rock, and now my head just looks like a rock. But no, we spent a lot of time really focusing on what is it that makes a good opportunity for somebody, and really it's understanding order flow. So we spent a lot of time. I didn't come from the floor. I'm a trained off the charts kind of guy, but I learned to understand what does filled and unfilled orders look like, and that's what we really spent our time talking about.
Cool. Thanks, Chuck. And then last but not least, Jeff Tompkins from Altos Trading. Jeff.
Hello. Yep. Thanks for having me. So I've been trading about 23 years. I trade options, futures, equities, ETFs. I'm a hedge fund manager, so I manage the Altos Capital Hedge Fund. Then the other side of our firm, Altos Trading, is our publishing entity. So we publish newsletters, trade alerts, financial courses, etc. Been doing that on the publishing side for about 8 years, and glad to be here.
Cool. Thanks for coming. Okay, so again, viewers, I encourage you to type questions in the comment section. We'll try to get to those for sure. But we're going to start up with some simple ones, so some layups. And Jeff, I'm going to start with you again, so keep your mic hot. We'll go back around the other way. So the whole show has been centered on technical analysis. Okay, so can each of you just sort of in your own way define how what it is? What is technical analysis? I know Jason might have a very different answer from the rest of you guys based on where his strength is. But how do you view this technical analysis concept? What is it to you? What does it mean? And in some basic terms. What do you think?
Yeah, sure. So, I mean, technical analysis, I guess at the very core, eliminates fundamental analysis, right? So we're not looking at fundamental variables. We're looking at technical patterns or numbers or indicator that are on our charts. So at the core, I think that's really what technical analysis is. It's in terms of interpretation different from fundamental analysis. If we get a CPI report or a Fed meeting and they raise the rates, those are pretty hard fundamental numbers. And there's not necessarily, I mean, there's always subjective interpretation, but as it comes to technical analysis, I think there's a lot more subjective interpretation around that. For instance, we can take an indicator or a chart pattern and show it to 100 different traders, and they're all going to look at it and act on it differently. So I think that leaves a lot of room for education around technical analysis. And to me, that's really what it is, and how it differs from like fundamental analysis, which are kind of obviously the two baskets we look at as traders and investors.
Got it. Chuck, what do you think?
Yeah, you know what? My thought is that price is king, right? So, technical analysis in my mind is just the study of price and volume, but primarily it's understanding where the filled and unfilled orders. And every candlestick we look at is the result of orders being filled, and price movement exists because of unfilled orders. And so what I'm primarily looking for when I think about technical analysis, I think about filled and unfilled orders. Every indicator that exists is nothing more than a mathematical permutation of price and volume. And so I don't really use many indicators. I just primarily focus on the price action of what picture of price was there when it came to filled and unfilled orders. So technical analysis in my mind, is because it's the study of what actually happened.
Okay, got it. Thanks, Chuck. Jason, you might have the most different answer of everybody here, so I'm counting on
All right, you can wait for me to be last. I don't want to cross Jeff because he has a gun, a massage chair, and a guitar, so he knows how to party.
Hey, by the way, yeah, I didn't realize my camera angle was so wide, but that's part of my technical strategy, so I'll share that later.
Okay.
Shotgun approach.
That's it. All right, Jason, go ahead, sorry.
Do you want me to go, or do you want to go Rob first?
Oh, I was going to go you. I'm going around the horn, but
okay, that's fine. So for me, technical analysis is analysis based on the price, both current and prior. So it's like kind of a running price. So anything momentum related, anything that has to do with moving averages, candlesticks, and it's basically trying to find patterns in the price of a security and trading on it. So that's kind of my definition of technical analysis. How I apply it, I think technical analysis is very distinct from any kind of flow analysis that Chuck was talking about mostly. And it's also distinct from fundamental analysis because both of those indicators are outside the scope of just straight price. So for me, technical analysis is anything that has to do with the price, whether historical. Volume is something that has to do with the price because it's how much that price is being traded. So it's kind of aspects in that sense.
Okay, great. Rob, I know you and I talked recently on a show, so you've got some pretty interesting ideas about this as well, I think.
Yeah, so I just wanted to remind Jeff of the old screenwriting rule that you never show a gun in Act 1 that you don't use later on in the movie. So I just want to remember that we do have to shoot one of the panelists today.
That's why it's there.
I'm going to put myself up there. You guys can, whatever. So my take on technical analysis is really similar to, I think, what Chuck said. I really appreciate what you said. It's not exactly the same thing, but I like to think of all market activity as price moving from one level to another. Now, the reasons behind it, I think, Chuck, you mentioned there's a logic behind it. There's something happening underneath the surface there. And I really love that explanation because it's not just cave drawings, right? There's something going on under the surface that creates that. But I think whatever technical indicators that you use, whatever it is, whether it's support and resistance lines or the volume weighted average price or moving averages or the Fibonacci spiral of death or whatever it is that you prefer, what you're really looking at is it bouncing off a level and returning to another one? Is it breaking through a level and going to another one? And that's really all we're trying to do. And we're all kind of trying to do the same things, and each of us chooses sort of our own path to get there. But I think what has been said here is there's something going on under the surface. There's more there than meets the eye. And I think that's what's so exciting about technical analysis to me, is that it represents order flow, or it represents that battle between the bulls and the bears. And I think that's why after 22 years, or as many years as we all have here, we're still interested in doing what we do.
Right. Very good. So the next question is, there's indicators, right? The RSIs, et cetera. And then there's candle reading and there's pattern reading. How do you incorporate, the combination of these two things? And do you have a favorite sort of setup or indicator that you use on a regular basis that just seems to be just money for you? Rob, why don't we just keep going, or just keep kind of.
So I'm going to share my screen, and so
go ahead.
I may break everything here, and I may show you something that you don't want to see, but that's fine. Just kidding. All right.
Be careful what you share, Rob.
That's right. Wait,
I was actually on a webinar one time where a guy was like to 1,000 people, and he pulled up and shared a screen, and then there was some interesting material on a screen, and he simply said, well, there's a fry pan bottom, and then he just went on with the rest of his presentation. He just
love it.
Didn't even miss a beat. All right, so
you might share. You got it here. Hold on. Here we go. There you go.
So this morning I was looking at a couple of different. So in the mornings, I'll either trade options or I'll trade low float, high volume stocks, and sometimes I'll even trade some of those pre-market. And so this morning, SINT was a reasonably low float stock. That means the float refers to the total number of available shares to trade. And the volume was outstripping the float pretty big. And I call that a float squeeze, even though that's not a real thing. And I'm just looking at the volume weighted average price. And I'm looking for price to break through that volume weighted average price. That to me is a level or a technical indicator that says, even pre-market, I might use an EXT order and trade before the market opens. That to me is a breakout. I'm looking for something to break out above its pre-market levels, above the volume weighted average price. And then what you mentioned is really, I love what you said. You said when you combine like candles and indicators. So this one wasn't a great one when it basically printed these side-by-side candle bodies. Like I was going to make a joke about me and Lex and Chuck, waking up next to each other, but like side by side there. And that's like the market freaking out. And there's an equal number of bears and bulls or whatever. And that's just my out. And that's kind of the combination of those things. I'm looking to get in on that breakout, sometimes even pre-market, ride that for a bit. And then, I'll use some historical support and resistance levels. But that candle pattern, I think that goes to answering the question that specifically you asked, is that kind of is what I'm looking. That's one of the things that's like sort of like, okay, now whatever you were doing, set it aside or move the stop to break even, but prepare that things are changing. And that's when I'm really rapid fire, either day trading options or day trading a low float, high volume stock.
Okay. Thanks, Rob. Jason, do you have something similar? Do you use the candles and the indicators?
So I'll share. Yeah, I'll share my screen. I don't use chart patterns per se. I kind of think, the technical trading has the reputation of like astrology for men or drawing on charts with crayons. I'm a little bit more or less in that camp. But one thing I was talking in my introduction about vol land, and one source of edge that I always look for is to try to front run price indiscriminate traders. And you market makers that were high stepping before, talking about how you can see all the flow when we can't. Basically, we're paying you to be, I don't want to say our slave, but you're being paid to take the opposite end of our trade. And you, the market makers, have to manage that risk. So what this tool does is we are looking at, I guess being introduced to options in this. I've been watching, and it seems like there's quite a bit of involvement in this summit. So we're looking at which is a price modeling version of how traders have to hedge their risk in order to stay risk neutral. And so this is an example. I'm using Apple, and these are all of the strikes in the options. You can see here on the x-axis, and the y-axis is how much they have to hedge, because you're not a market anymore, Lex, right? And in this particular case, we're looking at gamma. So we were talking before about how gamma is a little bit opaque to neutral. It is how much an acceleration hedging needed on the strikes that you own in options. So I take a look at the tool that we built, and if it is positive, if this gamma is positive, then makers have to buy, and if it's negative, market makers have to sell. So in this particular Greek, I look at where Apple is going toward the end of the day, and at the end of the day, the market makers, who are price indiscriminate buyers and sellers, will have to buy or sell in the amount of like say 20 million notional per point. So this is what I look at, and I am a swing trader. I am not a day trader. I just don't have the time for it. I like to eat lunch sometimes. So so I do this like on about a 1 week to 2 month basis. I will see what the patterns look like on the market maker Greek side, and when they have to buy, I buy before them, and when they have to sell, I sell before them, and it's worked out pretty well.
Great. Yeah. Well, we've done a lot of shows on this, and Chuck, I think I talked a little bit about this on one of at one of your conventions as well. So interesting stuff there. So Chuck, how do you use the combination of all this stuff?
Yeah. What's funny about me, kind of interesting, is I don't typically use indicators at all if I don't have to. To me, an indicator is it's simply going to be used as a confirmation tool, because I'm looking for the balance between where buyers ran out and sellers ran out, right? So essentially, and if everybody else is sharing their screen, I'll see if I can't do mine as well.
Yep.
When I look at, can you hopefully you can all see right now?
Not yet. Hit that share.
Oops, there we go. Sorry about that.
Sorry, it'll come up in a sec.
There it is. It's my first time using this one. Okay.
Hang on. Yep, I'm getting there.
Okay. So, for example, this is just something simple in the SPYs, right? And this is nothing crazy big, but when I look at something like this little area right here, where I've kind of highlighted this little price point, there's not a lot to see here, but we know for certain that in that period of time, there was an equilibrium of buyers and sellers. Buyers and sellers had to be equal. And so since they were equal in that period, we know that when price moved away, there were no more willing buyers. There couldn't have been. So the question is, did every sell order get filled? Don't know. Are more people going to see that and add their sell orders? So what we look for are turning points where the market has had balance in the past and may find them again. And that, to me, is where I would start to say, okay, well, maybe this would be a good opportunity for a small time frame reversal. Now, certainly that's inside of trend and all of that. This is just one example. I just pulled up a simple one, but the idea is that I'm typically looking for those around areas where a lot of traditional technical analysis traders are going to be trapped, right? So a lot of traditional technical analysis traders are going to utilize, say, this line up here and say, all right, well, if we break that resistance, I'm going to be a buyer. And I want to be, they're going to be buying right into an area where we know that institutions had to be selling in the past. How do we know they were selling? Well, we know they were selling because price fell away from that level. So I look for areas that essentially are areas where in the past, buyers and sellers decided, hey, listen, we're going to find some equilibrium, but price moved away from there. And then I want to go, where's there a trap? Where's a trap being laid where the novice traders that are all reading the same books, doing the same things, are going to place all their orders that enough. And I'm not saying, that's not to say that professionals are out there looking for everybody else, but there are certainly algorithmic trading systems that do that, that look for areas where there's going to be a mass influx of the money that follows the same tool.
Cool. Nice. Thanks, Chuck. Jeff, what do you think? Combinations of things? How do you look at this?
Yeah. I was going to say, I mean, if kind of combine what Rob, Jason, and Chuck all said and similar methodologies on my side, to echo what Chuck said, I think using it as far as an indicator goes, I use it more for confirmation than for the initial trade decision. Let me see if I can share my screen so I'm not the odd man out there.
Yeah, just pick the screen and it'll pop up for me and I can bring it in.
Yeah, all right. I'm on dual monitors, so I want to make sure I share.
Yeah, you'll get infinity if you pick the one you're looking at.
Yeah, so let me get over to the chart.
Yeah.
Let me know when you can see it.
I'm good. There you go.
Got it. Cool. Okay, so I'll actually share a trade I did this morning. So a real money trade using. So I look at price action first. So one of the core methodologies I use are pivot points, particularly because I use a lot of these forecasted directional, decisions to trade options, right? So being that they're a derivative instrument, I need to be pretty precise with my timing and those types of things. In this case, this is the E-mini S&P futures, so it didn't involve options, but I use this as a core price action setup for virtually all my trading decisions. And then I throw in, I have just a handful of indicators I can use for confirmation. So just to kind of explain what that is, I look for, again, for pivots. So this would be, and this is one I traded off this morning, shortly after a couple hours into the open. I'm looking for a shift in trend and momentum. So we had this, surge up in the markets this morning, and then we peaked around. I'm in the Mountain Time zone, so around 9:40. And what I'm looking for is a shift in making new highs. And this is a 5-minute chart, by the way, on the candlesticks. This is fractal, can be applied to any time frame. And I'm looking for a shift where we go from making new highs to making new lows. And that's purely price action based, right? We're not using any indicators. And oftentimes when that occurs, we get a follow through with the forecasted trend direction. In this case, that would be to the downside. So I spotted this one this morning, and I noticed we're in this big uptrend. And what I've also plotted here are the Bollinger Bands. So I'll explain a little bit how I use those for the confirmation. But what I'm looking for is, again, the pivot candle, which would be the candle here that I have my cursor over. And then I'm looking 2 candles to the left to see if we have lower highs, and then 2 candles to the right to make sure we have lower highs. And that gives us our confirmed pivot. And once that 5 candle pattern is in place, I'm looking to enter in the direction of the forecasted trend, in this case to the downside, at the low of the 5 candle pattern. But we just do the opposite with a bullish price action pivot. So here was one this just more recently today. And so entry would be right about down here, and this is where I entered. And then I typically manage with a scaling out technique where I put on multiple contracts and then scale out at a 1-to-1 risk reward. I usually define my risk above the high of the pivot candle, and then my reward at a 1-to-1, and then exit half the position, trail the rest. So I actually ended up getting out around 38.60 this morning on the E-minis to the downside, just using that price action pivot type of setup. But I also, as I mentioned, can combine an indicator with it. So one of the common ones I use are the Bollinger Bands. So these are basically volatility bands, and the default settings typically are a 2 standard deviation move from the mean. So each of the outer bands is a 2 standard deviation move from the center band. And that helps me determine if a market has been overstretched to the upside or the downside. So if it's overstretched to the upside and I get a bearish price action pivot, exactly like occurred this morning on the E-minis, then I have more confidence to take a short setup. Or if I get a volatility expansion to the downside and I get a bullish price action pivot, I have more confidence to take a counter trend trade. So basically what I'm looking for with the Bollinger Bands as far as confirmation is I'm looking for price to trail the 2 standard deviation band for an extended period of time. Because whatever market we're looking at, or whatever time frame we're looking at, markets can only sustain a 2 standard deviation move from the mean for so long before they mean revert or they completely reverse course. So you see this happen all the time, right? So I think when you combine, indicators and the right ones, there's a lot of crappy indicators out there. I really like the Bollinger Bands because they give us volatility information, they give us directional movement information, and they give us standard deviation moves. So when we combine those with price action, I think they can be very effective, and that's kind of how I use them. I look for overextensions, 2 standard deviation moves from the mean, and combine those with price action study like the pivot strategy.
Great. All right. Good deal. Let me go back. So that's awesome. So
actually, Lex, one thing. Sorry.
Yep.
And then once I hit the winning trade,
yep.
I go ahead and get the shotgun out. I load 2 12-gauge shells in, and I go outside and fire it up. So that's actually why that's back there.
I think I like that. That's very good.
Then I hope the police don't show up.
You're far enough out, nobody cares, Jeff.
That's right.
Exactly. Yeah. I'm out in the woods.
All right, Jeff, I'm gonna keep you warm. Okay, we're going back the other way. So, next question. Ready? Having learned all this, and you guys expressing your kind of what your setups are, what have you. What's the best option strategy that you can employ to take advantage of these price actions and indicators? Do you have a favorite? And if so, why? And what are some strengths to it? What are some weaknesses potentially? So if you could talk around that, that'd be awesome. Jeff, you want to go?
Yeah, I really like that question because I think all of us that trade options have a favorite strategy or a go-to strategy.
Yep.
I think that could also be a bit of an Achilles heel. So what often happens with options traders is we have a favorite strategy and we identify a technical pattern or a fundamental pattern that results in us making a directional trading decision. And then we go to that go-to option strategy. And it might not actually be the correct strategy for the market. So I think that's one of the mistakes that options traders make is they stick with one or two option strategies that they like. And then they see them, when they've worked so well, see them fail as market conditions change. One of those variables might be volatility, right? So some strategies option strategies work very well in volatile markets, and some are more conducive to low volatility conditions. So I think that the key there in what I do is to really have a toolbox of option strategies that you can go to, that you're familiar with, that you're experienced trading. And then based on market conditions, you choose which one makes the most sense. And just as a quick example, I don't want to take away time from the other speakers, but one of those kind of an example of how we would make that decision is with volatility skew. So, just like most markets, you want to buy low and sell high, right? So a mistake a lot of options traders make is they buy high volatility and they sell low volatility. We want to do the opposite. So if you're doing like for instance, a vertical spread, you want to, within that spread, you want to make sure that you're selling the high IV, the high implied volatility, and buying the low implied volatility. And that will help us dictate which strategy we choose. So we might not want to set up a credit spread when we're selling the low IV and buying the high IV. Then we may want to actually look at doing a vertical debit spread. So it really helps us determine what strategy we use. And that's a big question mark for a lot of option traders. They don't know which strategy to use for which conditions. So,
okay, great, thanks, Chuck. What do you think?
Yeah, I would echo what Jeff said that it's an Achilles heel because, by the way, guilty. When I first started trading options, I was very, very similar to that in much the same way. And so, I'll give you an example. One of the things that I'm a big believer in is I don't necessarily have a favorite because I eliminate the emotional component. So down here is just a very simple volatility indicator. And I say I don't use a lot of price indicators. I do for volatility, this just shows me, my volatility in a given range or a given period. And then I shrunk it on me. Hold on.
Hang on. Let me get it for you there, Chuck. There you go. Oh yeah, just go. Yeah, type.
There we go. Okay. So if I'm in the upper fifth, we basically break our volatility down into 20%, bottom 20%, top 20%, middle 60. If I'm in that top 20%, I know that I have to be an option seller. There's no sense in being an option buyer. If I'm in the bottom 20%, I want to be an options buyer and not an option seller. And then in the middle 60, then we get into the nuances of which spread makes the most sense, whether it's a vertical credit, a vertical debit, some sort of a calendar diagonal, whatever that looks like. So I got away from having a preferred option strategy to really just saying, I'm going to do this strategy that the outlook of the stock tells me, whether I'm positive, very bullish, neutral, bearish, or very bearish. And then I cross-reference that with what does the volatility tell me of where I should go. And then from there, I don't have a choice. I've got to trade that strategy that fits that criteria.
Okay, great. Jason, you the man. You trade a lot of options. I know that.
I do. That's because, you see the flow, so you know I trade options. But but I don't have a particular favorite trade like option strategy. I do have, like Jeff said, I have a toolbox of option trade plans that I utilize for different environments. One thing, not to disagree with him, but I'm going to because he doesn't have the gun. Chuck said that, when there's high implied volatility, it typically, you'd want to be option seller. And when there's low implied volatility, you typically want to be an option buyer, which makes sense. But there's plenty of academic papers out there that talk about how high implied volatility tends to be too low and low implied volatility tends to be too high as far as comparing implied to real volatility. But that being said, I'm sitting there taking notes on what you guys are saying and extrapolating. But particularly in this current environment, skew is pretty flat. So if you find a good stock that you like that offers dividends, you could put a collar around it for pretty cheap and have edge on the dividend. Also, because skew is cheap, or skew is also flat on the horizontal, from a time spread standpoint, I like to put on calendars and diagonals and try to take advantage of the horizontal skew. So basically what I'm saying is that form a toolbox for the different environments that you will be in, and then apply those trade plans, not just the trade, but you have to have an entry and an exit plan, sometimes determined on price, sometimes determined on some sort of data, anything, and utilize it and stay disciplined in it. I think trade planning is the one advantage that retail investors have, flexible trade planning, than many institutions and funds.
Okay, thanks for that. Rob, what do you think?
So when it comes to, I agree with everything that everybody said, and I've learned a ton just by listening, and I'm intrigued by everything that everybody said, and I agree. You got to have different strategies for different times. But if you want to, if we're going to talk about what my favorite strategy is, then I'm going to come clean about two things. One, I'm a degenerate gambler. There's no benefit to me saying otherwise. I love trading, and I love short-term trading options. And my favorite strategy is, you can just Google, there's a couple of lists on the web. You can Google Chinese stocks listed on the US stock exchanges, and you're going to get a list of basically a bunch of trash. And you can disagree with me if you want, but it's a bunch of trash. And what I love to do is I love to see those pop up. Now, whether we're using the Bollinger Bands, I love that as an indicator, and some candle patterns to go along with it. Jeff, I love that. I love buying puts on garbage. So I love it when Bed Bath & Beyond pops up, not a Chinese company, but you know what I'm talking about. Or PDD, for like a week, a year and a half ago, the CEO of the Chinese company went missing, and then they reported numbers, and they were just all fake. I love buying puts on some of those companies which are in extended downtrends, generally don't have very transparent accounting, pop up and reach sort of a limit at a technical indicator, print a nice reversal pivot type candle pattern, and then I'll just buy options. I'll buy puts that are near the money, that expire within 2 weeks, sometimes 2 to 3 weeks, especially if I can get a monthly, that's great. And then I love doing that. So you're talking about my favorite strategy. I love sort of being a pessimist and betting against garbage. And I know that basically that turns me into sort of a degenerate gambler sometimes, but I do stop out of trades. I don't like extraordinarily large losses, but that's what I love to do. Out of everything that you could possibly do, if you put me on a deserted island and you made me trade one thing to get off the island, that would certainly be it.
The long put.
Yeah.
Yeah. That's where we grew up, on the floor. I was always a pessimist. I thought only bad things could happen because I always had the opposite side of everything, right? So I was so scared.
Chicago. I know.
I get it. So yeah, we were bred to think the worst, and we always had to have protection. That was it. I lived through a lot of crashes in my life, and it was scary. I'll tell you that. So
I like to ask the question, where are people being stupid? Like, I'm stupid. So when do I get euphoric? Like, what do I love that blinds me from reality? We've all seen this. We've seen this happen with Tesla. We've seen this. I love Tesla. I love the cars. I love the company. I think Elon Musk is a cool dude. But people get euphoric and wildly crazy. Zoom during the pandemic had like a 1,000 price to earnings ratio. I like to ask questions like, where are people becoming euphoric and stupid? And then where does it pay to be a pessimist?
Well, you could have done that in GME, I think. when it went euphoric, and I want to say the stock was trading 400 and the 800 calls with a couple weeks ago were $12 bid. Now, that seems a little bit high to me, but what do I know? I know someone who sold those and made a very lot of money, but I don't think I would have been scared to death to sell those. So.
Yeah. I mean, everybody else can speak to this, but there are tons of options that get purchased, which are for whatever hedging purposes or whatever, that are just absolute. It's just wild. It's wild that some of that stuff's out there, but everybody's got their own reasons. And I know there's hedging and all that other kind of stuff, but
yeah. All right, let's go around again. Rob, keep the mic warm. Ready? So, back to a little bit of my experience. When we were on the floor, we didn't use charts. Okay. We didn't use them at all. We didn't know how to use them. We didn't know what an indicator was. We had no concept of how to read a candle or pattern at all. And one of the dumbest jokes that went around our floor is there's a chart on every ship on the bottom of the ocean. So what's the point, right? So I guess my question is are there limitations and weaknesses of using technical analysis, especially around the world of options trading? I mean, is there anything that stands out that could be a sharp weakness? Some people say to me, it's a lagging indicator. Why do you want to look at a lagging indicator? So I said, I don't know the answer to that because I'm not smart enough and I don't know charting very well. So what do you think, Rob? We'll start with you.
Yeah, so I might disagree with others, and everyone here is entitled to their opinion, and there are people here that have made a lot more money than I have and been around a lot longer than I have as well. I don't believe there are bad indicators or bad technical stuff. I believe there's reasonable, smart people can disagree about that. I believe there's bad risk management. Mm-hmm. And no matter how firmly I believe that Billy is a worthless company, I bought the $9.50 or $9 puts that expire November 18th. No matter how convinced I am of that trade, if that thing breaks above $11 a share and I've lost a few $100s in exchange for the ability or the potential to make a few $1,000s, if I reach that limit, then whatever technical analysis I did, whatever theory I had in my mind, I have to just admit that it's wrong. So I think everything breaks, right? Everything. You ever heard the phrase, well, it can't go any lower or whatever, it can't go any higher. Of course it can. Like, no matter what, whatever you look at, whatever academic papers back you up, if Nassim Taleb comes over to your house and drinks a cup of coffee with you and convinces you that Bitcoin is worthless, Bitcoin could still go to 100,000 and everyone in the world can disagree with it. So I like to say, whatever you choose to focus on and whatever toolbox you have of a variety of strategies, don't ever get so married to those strategies that you can't see what's really actually happening. And I think, Chuck, you were the one that brought this up. Price action or whatever is actually what's happening. It's what's happening, not what you thought was going to happen. And, you can't just keep extending the goalposts and you can't keep removing your boundaries, because the market will take advantage of you and it will throw you in the trunk. It will drive you out to a field and it will shoot you in the face and it will leave you there like Jimmy Hoffa, and it will not feel bad about it. So you got to admit when you're wrong. And that's been my big weakness. So it hasn't been the charts. It's really been over the years when I've bet on stuff or I've gotten convinced of it, I've refused to admit when I'm wrong sometimes. And that's just very costly.
Okay, good. Jason, what do you think?
So I think there are pros and cons to technical analysis. I am not a proponent of chart patterns as a source of edge. I think that, first of all, I agree that price is what's happening. And I agree with Rob when he says that. And I also, when I'm looking at the strategies that Chuck and Jeff and Rob are showing, and they're showing kind of trend reversals, I think the common theme of what is good about technical analysis is that it provides a strong trade plan. And for me, planning is the most important part, including risk management, like Rob was saying, and being disciplined and following your plan. I've been shot in the face a couple times by the market by, not accounting for certain risks. And I've been shot in the face by not following my plan correctly. And I think that no matter what indicators you use, those are the two biggest things that you need to have on hand as a trader. And I think even prior to this roundtable, all the other presenters have basically said the same thing: trade planning, risk management, and that's pervasive. Other than that, though, when it comes to actual indicators, people say when the relative strength index reaches 80, then sell. Well, it could also reach 90. It could also reach 100. I mean, there's nothing saying that it can't come, that it has to come down at 80. There's no rules to that. When it crosses the 200-day moving average, that means sell or buy or something. Or when the 5-day moving average crosses the 200, all of that, it basically boils down to trade planning and levels. Again, for the retail investor, you are at a major disadvantage in that you're not the market maker that can see all the flows. You're not anything, you're basically a person with charts, and charts is all you have. And so I think that identifying patterns and forming a solid trade plan around them, I think is very essential for the retail investor. And then just one other comment. One thing that I see a lot, especially on Twitter or something, the price of something, like we sold off an SPX because we crossed below the 200-day moving average. That is absolutely not true. Like Rob said, there's something else going on underneath the surface that you kind of have to keep in mind. The technical indicator is not causation. Even if there is a correlation, you can't think that the technical indicator is the reason why something happened. So I guess that's my 2 cents. I don't know if I answered the question right, but
no right or wrong, Jason. You know that. Chuck, what do you think? Any limitations that you can focus on?
I think the limitations on technical analysis, for me, the biggest problem is the subjectivity that can be involved around it, right? People say, oh, it's following the trend. Well, what trend? The daily trend, the hourly trend, the 15-minute trend? Or people say, well, look, I use my Fibonacci levels. Well, where do you start it and where do you end it? And so I think there's a lot of subjectivity that can be involved in trading that make it inherently more difficult. And that's why I think it's a little bit more of an art than it is a science in many ways. I think it's a combination of an art and a science. And back to what those guys said, it's all about risk management, right? The whole idea is how do I manage and handle risk? So I think that there is a lot to be said for the junk that is out there. And that's because of the arbitrary nature of many of the tools. My whole goal is to minimize or even remove the arbitrariness by having a probability score on something. And if it scores high enough in probability, I have to take it. And if it scores, it's kind of like what Rob said earlier, I only take trades that I have to take, that I just can't refuse. Similar to me is like from a technical analysis standpoint, I know that if I score it on a probability score and it scores a 9 or a 10, I have to take it. If it scores less than a 6, I don't take it. And so to remove that arbitrary nature, if you will, knowing that there's always going to be that piece there. So I do understand the whole, problems with technical analysis, because I think there are a lot of limitations when you focus on that.
Okay, great. Thanks. Jeff, any thoughts on this one?
Yeah, I guess the benefit of going last is I can just say copy that. I mean, everybody made good points. But no, I love Rob's comment. I mean, he hit the nail on the head that it's so often we focus on entry and technical analysis, and then that ties into what Jason said. Correlation is not causation. So you got to be careful if you see a technical pattern that might confirm what you believed in, then it's just basically correlation bias. So you have to be very careful of all those things. But really, it's the management of the trade that is crucial. And frankly, we see a lot of the marketing stuff out there these days that solely focuses on entries, right? Because that's what gets all the attention. And you seldom see the management component of it. And that's what really leads to the success. I think you could throw a dart at the dartboard, really. And, you might be getting some edge with some of these indicators and chart patterns and things, but you could throw a dart at the dartboard. There's the old kind of anecdote. You have two traders that walk into a room, trader A and trader B, and they both trade the same stock. One shorts it, one goes long, and they both make money, or they both lose money, right? They can both take the opposite direction and both make money or both lose money. Sure. So it's always important to keep that in mind. And yeah, I think as far as eliminating the chart, like you said, Lex, I mean, you didn't have charts to trade off of, but I don't think we really necessarily need them as it relates to the options market. So the beauty of options is you've got all of this technical information in real time, right? So you've got all your Greeks, you got your theta, your gamma, your delta, you've got your volatility information, you have implied moves, you have all this really great information that can actually allow you to make trading decisions without a chart, frankly. And I do that from time to time, especially if it's more of a swing to long-term trade opportunity where I don't need to be very precise in a short period of time. I predominantly just use the options information and don't really actually use the chart, because that can actually tell us whether it makes sense to buy or sell. What is the market telling us? I think it was Rob that also threw in, taking a contrarian approach. If you see things getting too out of whack, often it makes sense to take the other side of it. So.
Got it. Good. Okay. We got a few more minutes left. We got a couple of points here in the comments. One of the ones I saw earlier, though, is, and I won't go around the board. I'll just let you, if you answer, we'll try to not to talk above each other. People are always confused on time intervals. You use a daily chart, a minute chart. I know, Chuck, you might use a 60-minute chart, which is interesting to you. Anyone have any thoughts on that? Chuck, you want to go first? Looks like you're eager to.
Yeah, I got some big thoughts on this, because I think this is where when I see traders falter, it's primarily because they don't understand time frames. And it's usually because they're looking at too many time frames. You can't see the forest through the trees. So my belief is this, and I want to stay consistent. If I'm going to be a swing trader, I'm going to use a weekly chart, a daily chart, and an hourly chart. That's it, nothing more. An hourly chart maybe to refine my entries, the daily to get in and out, and the weekly to tell me the trend. If I'm going to be a day trader, I might use a 4-hour chart. If I'm trading futures, a 4-hour chart for trend, a 60-minute chart for entry, and a 15-minute chart for trend. But my rule is I never look at more than 3 time frames. One, which is the big picture to tell me, am I a buyer or am I a seller? And that's going to be my general trend direction. 2 is what's my entry criteria. And then the 3rd is simply for refinement or stop losses. And I think I've taught in 10 countries and lots of continents and all over the world, thousands of people. And when I see people making mistakes, it's because they're using too many and the wrong time frames.
Okay, great point. Anyone else have a thought on time interval?
Well, time intervals are kind of like.
Talk a little bit about time intervals.
Yeah, go ahead. Yeah, Jason, go ahead.
Jason, you go, and then Rob, I'll take you after. Go ahead, Jason.
All right. So the one comment that I was going to have is, a lot of times I find that traders are making decisions on time intervals that are different than what they're paying attention to. And most of the time they're looking at every single tick. If somebody is bearish right now, and I think we've had a couple, I don't know where we're at now in S&P, but we've had a couple of strong upside days in a row. But they're bearish out until December or out until January. And they start getting panicky because we just saw a large move up, but their time frame that they're looking at is 3 months out. And I think that disconnect contributes more to early exits or late exits than anything else. So I don't look, as you know, I'm not really a chartist. I'm kind of like Jeff. I look at option statistics and dealer positioning or whatever, and make my decisions based on that more than I do based on the actual chart. But my one comment is, make sure that whatever time frame you are trading on, use the appropriate charts and also use that appropriate scope when you're looking at markets, like Chuck was saying.
Okay, great. Thanks, Jason. Go ahead, Rob.
So at the risk of being canceled, timeframes are like pronouns. You could use whatever ones you want these days, but you can't expect that it's going to make sense to everybody else. You have to use what's right for you. And I love the idea of settling into, whether you're a swing trader or a day trader, Chuck, or whatever it is, settling in. Like day trading from a weekly chart, it's just patently idiotic. But if you want to do it, don't let anybody convince you otherwise. Stay true to it. If it's working for you, the only true indicator of whether something works or not is if you're making money. And if you're not making money, then you're doing something wrong and you need to change. And so, but if you're making money, let the whole world argue with you about it, and they can just, what themselves. It doesn't matter. So I think it's settling into what tried and tested stuff works. Like, try that. If you want to be a day trader, start with that short-term combination. If you want to be a swing trader, try that out. But if it doesn't work for you, don't be afraid to try something else out.
Okay, good. Anyone else, Jeff? Anything on this? So you're like me. I look at second charts, second candles.
Yeah, I love it. Yeah.
Candles.
And then you look back and say, I wish I would have traded that.
That's right. I have no attention span for anything longer.
No, yeah, I just once again agree with what everybody said, and I think it's just to sum it up, it's a subjective thing, right? Is it a 5-minute chart isn't right for every trader. It might be right for one and wrong for the other. So it depends on other, personal subjective variables. Is it, I can't remember if it was Jason that said, earlier on, if you're not a day trader, you don't want to sit in front of your screen. You want to go have lunch and stuff. Then why would you trade an intraday chart? I mean, you're just setting yourself up for failure. So it's important to trade, the time frame that fits your personality and your style.
Yep. Okay, great. So guess what? That's time for us. Sorry. I mean, that went by fast. That was great, guys. I really appreciate you coming on. Really informative. I love, everyone has a little different approach, and there's a lot of agreement too. So really great getting your perspectives. Thanks for coming on.
Awesome.
Guess what we're doing next? I'll let you on for a little bit here before we take our next little break. I think it's only a 5-minute or something. We're going to give something else away. Again, a shirt off my back that's sitting in the closet, and we're going to throw $100 in your account, and you have to answer a question. Okay, you ready? And Kayla said, don't make these answers so hard. My gosh, I was typing too much. So here's a question. It's going to be either or. Okay, and the question is, which option strategy flies? A butterfly or an iron condor? Those are your only two choices. Type that into the comments. If you get it right, you get into the wheel to win one of these unbelievable shirts from NikkiCClothing.com, NikkiCClothing.com, 20% off with options 20. But let's try to win one of these. Guys, thanks for coming on. Appreciate it.
Appreciate you having us.
Thanks, everybody. It was great to see you.
Thanks. Bye.
Bye-bye.